In this chapter, we are dealing with equity market, stock market, and also some simple stock valuation method. The key concepts are you need to understand how stock price is really dependent on its future dividend and also its future dividend growth. So we're going to use some pricing model, which is basically based on the dividend growth. We call it dividend growth model. And let's look at the chapter outline here. Chapter section 1 is for common stock valuation. Section 2, some feature of common stocks. We also briefly discuss what is the preferred stocks are. Last but not least, I'll give you some website address you can take a look at the stock market conditions, the current stock market conditions. Now, if you own a share of stock, you basically can receive cash in two ways. One, if the company pay you dividend, you receive the dividend income. Or you also can sell the stocks. If you sell it at a high price, you have the capital gain. You sell the stock, you get your money. So there are two sources. One is the dividend income or the capital appreciation. On the other hand, with bonds, the price of stock, just like bonds, the price of stock is the present value of its future expected cash flows. So the dividend generate cash income. On the other hand, if you're selling the stock when the price go up, you have a capital gain. Now let's look at the one period example. By the way, in this section, we have to rely on mathematical formulas. Okay, we have to use math formulas. There is no like a time value money to we can use. We have to use the math formulas. Now suppose you are thinking buy a stock. You expected that stock within next year will pay you $2 dividend. And that particular stock, you think a year from now, you can sell it for $14. Now, if you require the rate of return for your investment, because you take a certain risk, particularly the 14% might not realize, you want 20% rate of return, which reflect the risk you are taking. The question is, how much you will pay for this stock? Notice, what is the current price you will pay? Now let's look at this model in mathematical formula here. We're using D1. 1 indicates next dividend. That dividend will pay in 1 year, the end of next year. D1. Okay, $2. Your required rate of return is 20%. And the price of that stock is 14%. So if you think about cash flows, at the end of period 1, the next period, end of next period, you receive 2 dividend plus the selling price of $14. The total cash flow for you, excuse me, is $16. Now we can calculate what's the present value for that. How do we calculate present value? On the numerator is $16 is the cash flow at the end of next year, expected cash flow next year. You discount it back by 20% interest rate. 1 is the principal. Divide by 1.2. Or this is the present value for a $16 future value, 20% interest rate, period 1. The value of this stock if you'll give you 20% return, the price should be 13.33. You do the calculation, okay? So it give you though this one will give you 20% rate of return. Now let's think about, instead of a 1 period, let's think of 2 period. Let's assuming this for 2 years. Now, 2 years, let's assuming the stock dividend will increase. The first year dividend is $2. Second year dividend will be $2.10. Now, assuming that you receive the dividend, first year dividend you paid out to shareholders. The first cash flow is the dividend you receive, $2. Next cash flow at the end of second year is the dividend, second year dividend plus $14.70, your selling price, expect selling price. So the net of cash inflow at the end of second year, 16.8. Then you have 2 periods. How much is the present value for that? First, you calculate the present value of $2 dividend for first period, for 1 period. The next one was 16.80 discounted 2 period. Add them up. The present value equal to $13.33. Dividend. So you basically now from 1 period, we expanded 2 period, we expanded to 3 period. You're not going to set a stop. You'll keep on for 3 years. In 3 years, for example, the dividend first year is $2. Second year dividend you receive 2.1. The third year 2.205. Plus the selling price 15.435. So what is the present value for that 3 cash flows? Mathematical formula give us 13.33. You can use in cash flow to calculate that 3 uneven cash flows. The present value is 13.3. What that mean? You mean the value is going up as the dividend grow. As the dividend grow. So you can, for example, in this 3 case example, we can use the financial calculator, CF keys, cash flow keys. The current value, let's cash inflow is 0. 1 year from now, $2. 2 year from now, 2.1. The third year, end of third year, you have a dividend plus the selling price. Total amount of cash flow 17.6. You key those things in, then using MPV view, put your discount rate 20%. Using arrow key down, you compute for MPV. The value is 13.33. Now this is how you calculate the 3 cash flows. Now based on the expansion, we can do 4 period, 5 period, 6 period. Let an n grow more and more. You will find out the price of stock is really just the present value of all expected future dividend. You just pay the present value of a future dividend payoff. So mathematically, let's assuming the company will live forever. Let's go to infinity. So dividend 1 is at the end of first year, dividend 2, end of second year, dividend 3, end of third year, dividend infinity, that's very many years later. Now this one is what we call infinite theory. Mathematically, we come up with a summation, sigma summation, from next period up to infinity. So that is how do we calculate the present value. You just added the present value of all future dividend. Now, the book have 3 dividend cases let you calculate the stock price. 3 cases, depending on dividend growth. One case called a constant dividend. That means if the company has no growth opportunity, 0 growth, that means the company will pay you a constant dividend forever. Now this is a preferred stocks. Preferred stock is not really a stock. It is just like a bond, hybrid between bond and a stock. Why we call it like a bond? Because preferred stock, the dividend is fixed. Let's say 10% or $100 per year. But the dividend, if you don't pay it, just like a coupon rate, it's $100 coupon payment. But if you miss the preferred stock dividend, you cannot force the company to bankruptcy. Not like a bond, because it's not the obligation. So in that case, it looks like a stock, not like a bond. But let's look at we call the 0 growth situation. The bond, the dividend never increase. How do we calculate that? Second one is the dividend growth is a constant number. Now this one also called a constant growth model. That means the company will increase the dividend by a constant percentage every period. Let's say like 5% per year. Right? Constantly, that number. The third one is what we call a supernormal growth, different growth model. That model is a little bit too complicated for this class. So let's skip that part. We only do the first 2. Let me give you some examples. First, let's look at a 0 growth. What kind of company is 0 growth? The company have no opportunity to grow their sales. A good example is the tobacco industry. Right? The growth is not really, not many, the sales growth. Let's assuming the expected growth dividend at regular each year go forever. Let's say also like 6 months or 1 year. Let's using 1 year. Go forever. Now it's a perpetuity, isn't it? It pay you $100 since the company live forever. So it's perpetuity. We know the perpetuity formula is equal to the present value equal to dividend in dollar term divided by cost of a capital. R is the required rate of return. Let's suppose there is a stock is expected to pay you dividend 50 cents every quarter. And the company's APR, the cost of required rate of return for this stock, is 10% per year. But they are quarterly compounding. I mean 3 months, 3 months, 3 months. So what is the price? So how do we do it? Now we're using the perpetuity formula. The value of the stock today, 0 means today, is equal to the dividend 0.5 divided by 10% divided by 4 or 0.1 divided by 4. Since we are using formula, we're using decimal point. You cannot divide by 0.1 because it's annual rate. You pay the quarterly. So this part you have to adjust for quarterly rate. So mathematically, you need to calculate 0.1 divided by 4 equal to 0.025. Then your result is $20. Now that is the company stock price. It's $20. So 0 growth. Now that's the easy one. Second one is the constant growth model. If the company's dividend are expected to grow forever at a constant rate G, let's say G equal to 10%. Now, let's get used to the index numbers. D index 1 is next period dividend, which is last period D0. It's already paid. D0 times 1 plus G for 1 period. Now, second dividend at the end of second year is You compound twice, right? Now remember the D0 D0 is the last dividend or the dividend just paid, already occurred. D1 is expected next period. Make sure that you distinguish these two. D0 is last dividend, already paid. D1 is next dividend, not paid yet, you expect it. What the relationship? D1 equal to D0 times 1 plus growth rate. That's the relationship. Now let's look at a stock has a projected dividend, $2. A projected dividend, how do we calculate projected dividends? The last dividend they paid, already paid, is $2. But we know the company, the dividend will grow at 6%. What is next dividend? Next dividend equal to D0 times 1 plus G. You calculate the internal, inside the bracket is 2 times 1.06 equal to 2.12. Right. D2 then is a D1 times 1 plus G, 2.2472. Well, you have a fourth decimal point, right? Do the calculation. Now, let's make it simple. Go ahead. Here, you also will go forever. You have another type of infinite series. But we can summarize in the formula, the following formula. The expected value of the present value of this stock when its growth equal to G, dividend growth equal to G, is equal to, the numerator is D0 times 1 plus G, parenthesis, the whole thing, then divided by discount rate minus dividend growth rate. Discount rate also cost of capitals. That is the final solution from the infinite theory. Now, the following model, also called Gordon growth model, also can be rewrite into D1. D1 divided by R minus G. Why this one is equal? Because D1 is equal to D0 times 1 plus G. So these two formulas are interchangeable, depending on the parameter you are given. If you are told last dividend is $2, you're using this formula. If you say next is $2, then using D1. It's another D0. So make sure that last and the next. Let's do one example. Suppose a company called Big D just paid a dividend of 50 cents. It is expected to increase its dividend by 2% per year. If the market requires a return of 15% on assets of this risk, how much should the stock be selling for? First, let's look at the input, 0.50. Is that D0 or D1? It's just paid. Oh, it's a last dividend, isn't it? So D0, you are given D0, which is 50 cents. Growth rate, 2%. Required rate of return, 15%. Now, when we using mathematical calculation, using decimal instead of using percentage. So we can looking at the example 1, plug those in. 0.5 times 1 plus 0.02 divided by 0.15 minus 0.02. Numerator divided denominator. What is the present value or the price today? 0 today is $3.92. Example 1, you are given a lost dividend, the dividend growth model 1. Let's look at another example, example 2. Suppose TB Pirates is expected to pay a $2 dividend in 1 year. Stop here. So is the $2 dividend is the last dividend or next dividend? We know the last will be D0. Next will be D1. Since this one paid in 1 year, so you are given D1, not D0. Then the formula will be D1 divided by R minus G. You need like, the example 1 is the last dividend. So you need to grow at 2%. This one, you are next dividend. So here's the difference, right? So do the calculation. Next dividend, $2 divided by cost of a capital 20% minus 0.05. The result is 13.33. This is your calculation. Okay. Now the stock price are positively related with the dividend growth rate. High growth rate, high stock price. Right, the stock price increase at an accelerated rate. On the other hand, the stock value is a decrease function when the cost of capital or required rate of return is low versus high. High rate, then the value will go down. Now let's look at another example. Example 7.3. Gordon Growth Company is expected to pay a dividend of $4 next period. And the dividends are expected to grow at 6% per year. Required rate of return 16%. How much you will pay for this stock? Most important thing is the $4 D0 or D1? This is implied, expected next dividend. So is D1. So we're using this formula instead of D0 times 1 plus G. And the value for that stock is $40. Okay. The homework assignment I ask you to do is one problem is similar like this. Okay. But you need to distinguish is that last dividend, which you're using D0 formula, or next dividend using D1. The other exercise is using preferred stock. Asking you to do just using the perpetuity model to do it. Okay. The constant growth model condition are, number 1, the dividend expected to grow at the G, 10%, 8%, 2%, forever. And the stock price then also will grow. Expected dividend yield in that case is constant. And the expected capital gain yield is constant. Expected total rate of return is R. But in order for this formula to work, the dividend growth rate should be less than the required rate of return. Otherwise, the formula does not work. You have a negative in the denominator. The expected total rate of return, as a matter of fact, is equal to expected dividend yield plus expected growth rate. One is the income from dividend, ordinary income. The other one is capital gain. So which is equal to dividend yield plus G. Yeah, I'm going to skip the quick quiz part 1, since this one you can go over with to see formula, which formula you apply, D0 or D1, okay? All right. Here shows you how do you find required rate of return given the dividend growth model. Now, the mathematical formulas say that if we just using D1, P0 equal to D1 over R minus G if we're given next dividend. How do I isolate R? Here is a rearrange it. Time R minus G on both sides. Isolate R, then which is equal to D1 divided by P0 plus G. In other words, sometimes you need to find out what is the required rate of return for this company, given the company current price unknown. Then using this formula to calculate the R. Here's an example, show you how do you find the required rate of return. A company's stock currently is selling for $10.50. They just paid a $1 dividend, and the dividend I expect to grow at 5% per year. Question, what is the required rate of return? We're using that formula, the early formula, but you need to make sure that what the dividend $1 is a D0 a D1. Here, the $1 is a D0. So we have to using the formula look like this. D0 times 1 plus G equal to P0. $1 times 1.05 divided by the current price, $10.50. Plus G. G is a growth rate, which is equal to 15%. Okay? So the required rate of return is 15%. You have, just given the current market price, you go backwards to find what is the required rate of return. The third type of non-constant growth model is too complicated. We're going to skip that. So for this class, we only do two. One is the constant growth model, which is the perpetuity, D divided by R. Second is the constant growth model. It's equal to D1 divided by R minus G. D1 equal to D0 times 1 plus G. Let's ignore the other more complicated model. I want to spend some time to discuss some of the features of common stocks. As we showed in our comparison before bond and equities, fixed income and equities, we said that bond has no voting right, but a common stock has. The common stock have the voting right. You are the owner of the company, therefore, stockholder can elect directors. Now, the voting right can be straight vote, or it can be cumulative vote. Cumulative vote, you can put all your vote on each chair, on single chair. And it's that one that allow the minority shareholder to have some kind of voice on the board. Now, in order to control the voting right, some of the founders, the share, have more voting right per share. Like a F class for Ford is held by Ford Foundation, the owner of automotive. They one vote, you have a full voting right, right? Class A, Class B, etc. Those are basically because the more voting right, more valuable the stocks are because you have more control on the board. Other right for a common stocks is share proportionally in declared dividend. More share, you have more dividend. When the company asset get liquidation, be sold at the very end, if finally liquidate, you will be paid up according to the proportion of shareholder you hold. The more share you have, you pay more. Also, the common stock have preemptive right. What is preemptive right? Preemptive right is the right of a first refusal. So if the company currently have 100 share outstanding, Mary has 60 share, John have 40 share. Mary is a majority shareholders. If the company decide issue additional 100, they will offer that to Mary first. So you can buy up to 60, so you still can keep as a majority shareholder. If you don't want to buy it, we can raise capital over the market. So that is called first refusals. It's part of control. How do you control the company? So let the original owner have first right to still keep the majority. But if you refuse it, then you can sell to the market. Dividends are not liability, by the way. There's a big difference between a dividend and a coupon in bonds. Coupon is liability. Interest payment is liability. You have to pay it. Otherwise, you are getting into trouble, financial distress, bankruptcy. But dividend is not. Dividend only paid by declaration by board of directors. Decide we're going to pay dividend. Therefore, a company cannot go bankruptcy for not declare dividends. So there is no obligations. But most common practice, if you pay dividend, you keep on paying it. If you reduce dividend, usually company stock will suffer. All right. Dividends are not tax deductible. Therefore, equity cost is much higher for the same company, higher than the bond cost. And the dividend are paid ordinary income, whatever the shareholders. You pay dividend is after pay corporate tax, net income, right? The bottom line net income, you pay dividend. The shareholders will pay personal tax on the dividend they receive. This is the double taxation. Okay, so it's a dividend payout. Now, on the other hand, preferred stocks. The name suggested, it seems like a better than stock. No, as a matter of fact, it's not. But on the other hand, preferred stock, you don't have to pay, but you have to pay it before the common stock receive their payment. There is some kind of a clause to prevent that. A dividend for preferred stock is not liability. You can be deferred. Okay. But if the preferred stock are cumulative, missed preferred stocks, preferred dividend, have to be paid before common dividend can be paid. In most cases, preferred stock carry no voting right, so there is no control. Okay, it's a sheer profit, but not control of the management. So in that case, average people should not really touch preferred stocks. Common stock is what you need to look at. Now, in stock market, we have primary market and the secondary market. A primary market for new issue, like an IPO you issue to the market, usually is the institutional investor involved. Now, when issue IPO, the company issue, let's say, 10,000 shares. So the company will receive amount of money. The price they sold to the primary market will reflect on a company's balance sheet, how many stock how much they sold. Now after IPO, then the stock can be sold on the secondary market. Secondary market are existing share traded among investors. So when we're talking about invest in stock, usually people are talking about secondary market. Now, difference between the dealer versus brokers is basically who take inventories. Dealer maintain an inventory on stocks. They really buy, sell anytime. So you own the stock, you buy and sell. It's more costly. On the other hand, stock brokers, you just bring sell, buy together, like a real estate brokers. You don't own the house. But on the other hand, if you're a stock dealer, you've traded dealership on the New York Stock Exchange, you own the particular company's stocks. Now here are for our class, one of the preferred financial web page I'm using is a finance.yahoo.com. It has all those information. The other one is a very good one, Bloomberg. I think this one is Bloomberg notation. They showed you, here is Harley Davidson's, their stock symbol, hawk. Interesting. On that day, the stock price is $59.2. Those are the old data. They will tell you this stock on that particular day increased 40 cents. In percentage-wise, is 0.68% at 1:54 p.m. in the afternoon. All right. Now, open price is 59.11, but increased. They have all those, the day range trading from 58.75 to 59. Now, if you're looking at the chart, it basically just show you Harley Davidson stock price for that particular day in the morning, going down, going up, or going down. You see, very volatile. The price quotation or give you those information. You can try it. You just click the web page. They will lead you to the Bloomberg. Then you can click the particularly Dow Jones. Let me see what the Dow Jones today is going up. Increase a little bit. Oh, today is going up. It'll just show you what the value is, right? But the other one is the Yahoo Finance page. Also give those information. One thing is you find stock price is very volatile. The price change a lot. It's much more volatile. For the same company, stocks are always riskier than the bond. For the same reason, because when you liquid, the bondholder get paid first. What the residue go to the stockholder. So stockholder has the residue values. But on the other hand, using financial leverage, like borrow other people's money, invest, take a risk. If the stock jump drastically, you benefit from you taking the risk investment in stocks. So you can click the icon to look at some of the company if you want looking at to see how that traded. By the way, like S&P 500 is an index which showed you the U.S. stock market as a whole going up, going down. This is about the stock market, the stock price quotation. Please work on your homework on that two problems. One is the preferred stock model, which is a perpetuity. The other one is constant growth model. Let me remind you, you need to make sure that the given data is appropriate. Is a D0, which is the last dividend, or D1, next dividend, using different formula. Okay, because we know D1 is equal to D0 times 1 plus G. All right. Okay, I'll see you next week.